Is our global financial system headed toward an inevitable monetary debasement that will make Bitcoin the ultimate safe haven? As the Federal Reserve continues its policy balancing act, understanding how Bitcoin responds to liquidity changes could be crucial for protecting your wealth. Our guest, Peruvian Bull, is a macro analyst known for his deep understanding of monetary policy and Bitcoin's role in the financial ecosystem. In today's discussion, we'll examine three central points: Bitcoin's amplified response to liquidity injections compared to gold, how gold historically front-runs QE by 12 to 18 months, and why central banks are trapped in a debt spiral that makes endless money printing inevitable. The implications of this debt trap extend far beyond market cycles. It suggests our entire monetary system is approaching a breaking point. Let's start with how Bitcoin's sensitivity to liquidity changes makes it the ultimate inflation hedge in today's environment.
And obviously, like you said, gold has much less sensitivity to changes in global liquidity than Bitcoin does. Like we're talking orders of magnitude, well, not orders of magnitude, but multiples less. If net liquidity grows by $1, gold might go up by $1.50, and Bitcoin might go up by $5. Like it's that severe. But gold has historically been this front runner of global liquidity, and so if you take the gold chart and you I guess you push it forward or push it back to the price of Bitcoin, it also foretells of a massive rise in the Bitcoin price in the next 6 months or so. And so if the gold price is correct right now, which I think it is, it's signaling that there's essentially another wave of QE coming, and that wave is going to be pretty substantial, and that will result in obviously higher Bitcoin prices.
When Peruvian Bull talks about Bitcoin versus gold's sensitivity to global liquidity, he's highlighting why Bitcoin works so well against monetary expansion. Think of it as a multiplier effect. When central banks print money, all assets respond differently. Gold has been the traditional inflation hedge for centuries. But Bitcoin has a much stronger reaction to liquidity changes. If you inject $1 of new money into the system, gold might give you $1.50 in appreciation, while Bitcoin might give you $5. This dramatic difference makes Bitcoin potentially much more valuable against monetary debasement. This sensitivity comes from Bitcoin's fixed supply of 21 million coins, creating scarcity that becomes more powerful as money enters the system. Unlike gold, which can be mined in greater quantities as prices rise, Bitcoin's issuance is unchangeable. What's interesting is how Peruvian Bull connects gold's price action to Bitcoin's future movement. Gold moves first, but Bitcoin follows with greater magnitude. With gold hitting new all-time highs above $2,800 per ounce, this theory suggests Bitcoin is poised for a significant upward move. When central banks create money, Bitcoin's perfect scarcity makes it particularly attractive during expansion periods. As buyers enter with newly created money, Bitcoin's limited supply creates a more dramatic price response than gold or other assets. When Peruvian Bull says gold price is signaling another wave of QE coming, he's reading the economic tea leaves. If he's right, Bitcoin won't just follow gold's path, and it will dramatically outperform it due to this enhanced liquidity sensitivity. We've seen how Bitcoin's higher sensitivity makes it an amplified hedge against monetary expansion. But why is gold front-running QE? The next clip explains this historical pattern that strengthens Bitcoin's case, and you'll want to stick around for the final clip where we'll discover why central banks are trapped in a debt spiral that makes money printing inevitable.
Gold has historically, and again, I wrote another Substack piece about this called Printer is Coming back in October of last year, but gold has historically front run waves of QE by about 12 to 18 months. So if you go back to the first gold bull market, or maybe not the first, but the first major one in this century in 2005 to 2011, gold front ran the first major waves of QE, first in 2008, and then the next QE2 that started in 2011, 2012, and even QE3. And then once, QE was seen to not be, like, the balance sheet was stabilized, gold started to get ground down again and fall to its, all-time lows of like 1,050 an ounce or whatever, or I guess, 10-year lows. And then we saw it front run even before COVID. We saw in December 2018, gold start to enter a bull market rally and basically, front run the QE and run all the way up to $2,000 and 2,070 an ounce in August of 2020, while the Fed was just starting QE. And then obviously it started to retrace as the Fed was doing more QE. But what it was doing was it was foretelling of the taper cycle, which you follow it, August 2020, 18 months later, is roughly when the Fed started to do, their taper.
This historical pattern Peruvian Bull describes is remarkably consistent. Gold serves as an early warning system for monetary policy shifts. Following a predictable sequence, gold rises first, then quantitative easing follows 12 to 18 months later, and Bitcoin amplifies the response. Quantitative easing is when central banks create money to buy government bonds and assets. It lowers interest rates and stimulates the economy, but increases the money supply. Exactly what Bitcoin was designed to hedge against. This pattern stretches back to the 2008 financial crisis. Gold started climbing before the Federal Reserve announced its first QE program. The same happened before QE2 and QE3, with gold anticipating each round of monetary expansion. The pattern repeated in 2018 to 2020. Gold started rallying in December 2018, well before pandemic responses. By August 2020, gold hit record highs around $2,070 per ounce as the Fed ramped up aggressive QE.
Everyone knows about Fold. It's the app where you can earn the most Bitcoin rewards for everyday purchases. Fold now lets you double stack rewards with gift cards. Use your credit or debit card to buy gift cards and earn both credit card rewards and sats. Fold gift cards help you grow your stack with every purchase. If you're not shopping with Fold gift cards, you're leaving sats on the table. Get a 20,000 sat welcome bonus. Go sign up now at foldapp.com/Marty.
For Bitcoin investors, this matters tremendously. If gold functions as a reliable leading indicator and Bitcoin has higher sensitivity to liquidity changes, then current gold all-time highs suggest Bitcoin is primed for a major upward move in the next 6 to 12 months. Since starting the TFTC podcast in 2017, I've watched Bitcoin lag gold's initial moves but then accelerate once liquidity hits the system. It's like gold is the tremor before the Bitcoin earthquake. What makes this current gold bull market noteworthy is that it's happening while interest rates remain high. Gold typically performs best in low interest rate environments. Gold hitting all-time highs despite higher rates suggests the market anticipates a major monetary policy shift that could substantially benefit Bitcoin holders. We've seen how Bitcoin has higher sensitivity to liquidity changes than gold, and how gold historically front-runs QE. But why is more QE inevitable? Our final clip explains the debt trap central banks have created that makes continued monetary expansion a mathematical certainty.
I called this the Peruvian Bull debt paradox. I had a tweet about it in like October 2022 that went kind of viral, where I was basically saying, like, here's the irony, is that the higher they hike, the further they move behind the curve, because with this debt load, you're raising rates into an environment where your interest expense will blow out, and then your borrowing rate obviously will blow out because you have to finance that additional interest expense cost, and then that means that the curve is essentially steepened more and more because you have to borrow more and more and pay more and more interest expense, and so the debt spiral accelerates, and that means that with the next wave of QE, when you have to do the next round of easing, you're going to have to be buying more bonds than you would if you hadn't hiked, ironically. And so there's truly no way out of this conundrum. Like, they're trapped in this black hole of their own design. There's no magic button they can press that will get them out of this. They either die via inflation by cutting rates to zero and doing QE, or they die eventually by inflation by raising rates to 5% and incurring a bunch of interest expense and accelerating the national debt spiral, and then lowering rates and buying a bunch of that debt that they caused in the first place. And so there's no easy solution for the Fed or for really any central bank that's facing above 120% debt to GDP. I mean, QE is really the only answer here. It's going to be infinite liquidity soon.
What Peruvian Bull calls the debt paradox is critical to understanding why Bitcoin serves as the ultimate hedge against monetary expansion. He's explaining a vicious cycle that central banks can't escape, one Bitcoin was designed to counter. When a country like the United States has accumulated over $34 trillion in debt, raising interest rates creates an immediate problem. Higher rates mean higher interest payments on existing debt. With debt levels exceeding 130% of GDP, even small rate increases translate to hundreds of billions in additional interest expenses. This creates what Peruvian Bull calls a black hole of their own design. When the Federal Reserve raises rates to fight inflation, they increase government borrowing costs. The government must borrow more just to pay interest, pushing rates even higher and creating a debt spiral. The numbers are staggering. The U.S. spent over $1 trillion on interest payments in fiscal year 2023, more than the defense budget. Approximately $10 trillion in U.S. debt needs to be rolled over in 2024 alone, nearly a third of the entire national debt. This trap forces central banks into an impossible choice. Either cut rates and restart QE, causing inflation, or keep rates higher and watch interest expenses consume more tax revenue, eventually leading to inflation when they're forced to monetize the debt. When debt to GDP exceeds 120 to 130%, countries historically face default, depression, or currency debasement. Despite the dollar's reserve currency status, mathematics always wins in the end. Bitcoin was created specifically for this inevitable outcome. Satoshi embedded a message in the Genesis block referencing bank bailouts, making it clear Bitcoin was designed as an alternative to a system dependent on endless money printing. With a fixed supply of 21 million, Bitcoin stands in opposition to the infinite liquidity that must eventually come. The insight isn't just that money printing is coming, it's that it's inevitable given our financial system structure. When Peruvian Bull says central banks are trapped, he means there's mathematically no path to normalcy. The debt levels are simply too high relative to the economy's productive capacity. This completes our three-part thesis on Bitcoin as the ultimate hedge against monetary expansion. We've seen Bitcoin's higher sensitivity to liquidity changes, how gold front-runs QE, and why central banks are trapped in a debt spiral making money printing a certainty. Do you think central banks will be able to escape the debt spiral, or is infinite liquidity inevitable? Let me know in the comments. I read every single one. And if you found this breakdown interesting, you'll want to watch our analysis of why gold markets are built on increasingly shaky promises. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble. Stack sats.